6 Things to know about Social Security and taxes. One of the popular myths about Social Security is that benefit payments are not subject to federal income taxes. This was true from the program's inception in the 1930s until Congress overhauled its financing in the 1980s, but for nearly 40 years, some portion of Social Security income has been taxable for some beneficiaries. Whether you are among them depends on your income. If you live on Social Security alone, it's unlikely you bring in enough money for your benefits to be taxed. If you have other income sources, such as work or retirement account withdrawals, chances are higher that you owe taxes on some of your benefits. Here are 6 things Social Security recipients, present and future, should know about the taxation of benefits. Number 1, income matters, age doesn't. Contrary to another common misperception, you don't stop paying taxes on your Social Security when you reach a certain age. Income, and income alone, dictates whether you owe federal taxes on your benefits. To make that determination, the IRS adds up your adjusted gross income, your tax-exempt interest income, and half of your Social Security benefits for the year. If this figure, sometimes called your combined or provisional income, exceeds $25,000 for an individual taxpayer or $32,000 for a married couple, a portion of your benefits is taxable. Those minimum thresholds haven't changed since the taxation of benefits was introduced. As incomes have risen in the decades since, so has the share of Social Security recipients whose benefits are taxed, from less than 10% in 1984 to about 56% now, according to Social Security Administration data. Number 2, you won't be taxed on all your benefits. Under an overhaul of Social Security's financing passed by Congress and signed by President Ronald Reagan in 1983, up to 50% of benefit income could be taxed if the recipient's combined income exceeded the limits previously mentioned. Budget legislation enacted a decade later under President Bill Clinton added a second, higher income threshold and made up to 85% of benefits taxable above it. Here's how it stands. Combined income under $25,000, single, or $32,000, couple, benefits are not taxed. The combined income of $25,000 to $34,000, single, or $32,000 to $44,000, couple, up to 50% of benefits can be taxed. Combined income above $34,000, single, or $44,000, couple, up to 85% of benefits can be taxed. The up to is important. Simply landing in one of those higher income tiers doesn't mean your benefits will be taxed to the maximum level. It's more like a sliding scale. The IRS has an online tool to determine how much of your Social Security income is taxable. Number 3, you can have federal taxes withheld from benefits. If you expect to owe taxes on your benefits, you can effectively prepay part of the bill by having taxes withheld from your monthly Social Security payments. You can opt in for withholding as part of your application for Social Security or do so later by filling out IRS Form W-4 volts and submitting it to a Social Security office. In either case, you can choose to have 7%, 10%, 12% or 22% of your benefits applied to your next IRS bill. Number 4, it isn't just retirement benefits. The taxation rules apply to all forms of benefits paid out of Social Security's trust funds, retirement benefits, survivor benefits, and Social Security disability insurance. Whatever type of Social Security benefit you get, you could owe taxes on it, depending on your overall income. They do not apply to supplemental security income, a separate safety net benefit that is administered by the SSA but paid out of general U.S. Treasury funds. SSI benefits support people with very low incomes and limited financial assets who are 65 or older, blind, or have a disability, and those payments are exempt from taxation. Number 5, taxes on benefits help pay benefits. By law, federal income taxes collected on benefits go into the government's Social Security and Medicare trust funds, meaning they contribute to future benefit payments. In 2021, income taxes on benefits added $37.6 billion to the Social Security trust funds, accounting for about 3.5% of Social Security's revenue, the vast majority of which comes from payroll taxes levied separately on most U.S. workers' earnings. Number 6, some states tax Social Security, too. Most states do not tax Social Security benefits. But if you live in Colorado, Connecticut, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, Rhode Island, Utah, Vermont or West Virginia. Some portion of your benefits may be subject to state income taxes, under widely varying rules and formulas. That money goes into the state's general funds. Most of these states use different criteria than the federal government for taxing Social Security payments, setting higher income thresholds, offering various deductions, or limiting benefits taxation in ways that exempt many beneficiaries. New Mexico, for example, recently changed its tax laws to make Social Security income fully deductible for residents with AGIs below $100,000 for an individual and $150,000 for a couple. In Missouri, the thresholds are $85,000 and $100,000, respectively. As of the 2022 tax year, Colorado residents age 65 and over can fully deduct their benefits. AARP has supported legislative efforts in multiple states to reduce or eliminate the taxation of benefits. To find out how benefits and other forms of retirement income are taxed in your state, check with its tax or revenue office.